Okay, good afternoon, everybody. I'd like to welcome everybody to the quarterly economic update that Peter Andersen presents that I moderate. We started this in early part of 2020 when COVID started, and I think it's been a great run. I think Peter does a great job of keeping everybody up to date. For those of you who don't know Peter, he's one of Canada's esteemed economists. He's a PhD grad from Harvard. He was a Woods Gordon intern, which later became Ernst& Young. Uh, he had the luxury of working at the Bank of Canada with our newly minted Prime Minister, who presented us with an $80 billion deficit of a budget last night. And Peter's taught when he emigrated to Texas at the University of Texas, where he taught in the business program, and he was the professor of the year, and he still serves some of Canada's uh, successful families. So I'm really happy to call Peter my friend, probably 25 to 30 years. It's been a great relationship. His son is now a client. And without further ado, I will let Peter take us through uh, what we can and cannot expect in 2026. So thanks for joining. This is being recorded, and we will send out the recording subsequent. And if you have any questions, please put them in the chat, and I will endeavor to put them together and ask Peter questions on 4 or 5 different topics that I think are going to come up today. Peter.
Jason, thank you. And for our friends that have signed in today, thank you very much for your time. It's a great honor to be able to share thoughts with you. And the way I think we're going to do this, I think it's going to be more like a podcast because we all know Jason pretty well. And we all know that he likes to jump in and get into a discussion on issues. So I think we're going to do that today. So this is kind of going to be like one of these podcasts that you might sign into, not just going to be a monologue coming from me. Is that okay with you, Jason? Are you good on that?
I'm good with that, Peter. I'll do my best.
Okay. My my first thought is get ready, everybody. Get ready for tomorrow. And I really mean 2026. Get ready for 2026. Um, we live in a world where 30 years or 40 years of past history and the cause and effect relationships that we've gotten used to don't really count anymore. We are in such a different, unpredictable space. It's interesting that when I started out as being a crystal ball forecaster, econometric models were the in thing. But these fancy statistical models, they rely on past behavior. And that's where we have a problem because past behavior and past cycles don't seem to matter anymore. So, Jason, I think we have to kind of learn to live in the present now. And I think we need common sense. How do you define common sense? It's not necessarily an econometric model that looks back 40 years and says, this is how it works. So, just to throw out a few things for 2026, tariffs. There's something going on there. Why hasn't there been a deal yet? Jason, why hasn't there been a deal between Canada and the US yet? There's something there that we really don't know about. There's something holding it up. And my worry is it's going to spill over into 2026 with no deal. And then we've got what we used to call NAFTA coming up for renegotiation. So that's going to be tricky. And then we've got AI. Have you noticed the way we are all using AI more today than we did 3 months ago or than we did 6 months ago. I mean, Copilot is our friend now. I mean, we can actually talk to Copilot as if it's, your psychologist. I was having trouble with my computer over the weekend, and it was so nice to talk to Copilot. Copilot was so reassuring, telling me my tech guy would be able to fix this up. Anyway, is there a bubble out there? Jason, you and I have lived through bubbles before. We've lived through the dot-com bubble, and we always like to hear the mantra, this time it's different. But bubbles happen, and when they happen, it happens unexpectedly. They just come out of the blue. So don't ever think that stock market crashes don't happen. Don't ever think that stock markets are efficient and that the price is always right, the price is always where it should be. So that's something to think about. So basically, I'm saying kind of we know they're the known unknowns. Hey, I think that was Donald Rumsfeld that first said that I remember. We know what the known unknowns are, but we don't know the rest, the unknown unknowns. So, ladies and gentlemen, what I'm saying, get ready for 2026. Expect the unexpected. And you know the best way to make an economic forecast? It's the same with weather. Figure out what's happening right now. Here we are, the 18th of November. Can you actually figure out what is happening to business conditions and the economy right now on November the 18th? If you can, you've got a leg up in getting ready for the future. But this is what I'd say. Beware of the consensus. Just because everybody's saying it, don't for 1 minute think that that's right. So beware of consensus thinking. And following on that, opinions. Beware of opinions. Opinions can be biased. And the more often you hear these opinions, the more you think they've got to be right. You know, there's a disconnect. And this is where I'm going. This is where I'm going, Jason. I'm going now thinking into the economic data. So I'm not ready for my first slide yet, but what I'm going to say is that we have two types of surveys. We've got surveys of people and we've got surveys of businesses. When you do a consumer sentiment or a consumer confidence survey, you get people's opinions that give you a biased result. Okay? When you talk to business people, they are more factual and they're more dealing with data. So a business survey is far more, what can I say, meaningful than a consumer survey. And that's what's happening right now, a huge disconnect. For example, you ask consumers, how are things? They're terrible. In fact, the index, the consumer confidence indexes, they're as low as you can get. And they've always in the past been reliable predictors for recessions. You talk to business people, you're getting different answers because business people are going beyond just opinions. They've actually got skin in the game. It's their business, and they're giving you honest answers. So we're getting a divergence here of messages. Okay, the opinion-based consumer surveys, it's the end of the world. And the business surveys say, we are still okay. We are still on solid ground. So what I'm saying to everybody is focus on facts. Forget the opinions, focus on facts. And Jason, I think the way to do that is to focus on the data. Focus on the data and be careful where you get the data from. Don't cherry pick it. Be an honest analyst. Cut through the noise to get to the message. Okay, that's my opening comment, Jason. What do you think?
I think that was great, Peter. I think uh, people are becoming more and more aware of how important data is in every industry. And we've just gone through the shutdown, the government shutdown in the US for the longest period of time. And so the economy and economic data has not been available. And there has been data that has been used from private sector sources over the last 45 days to try and take the place. With respect to AI and private sector data, how do you believe economic forecasts and the use of private data and government data is going to be utilized more importantly? But I think one of the things that's important that you always talk about is the timeliness and the availability of the data and
Right.
how current it is. Because in today's world, something that happened last week has already changed.
Let me comment on that because this is something that has really grabbed me ever since the 1st of October when we had the shutdown begin in the United States. Because, I'm a kind of a data hound, and I've come to rely so much on government produced data on both sides of the border. But listen to this. The Federal Reserve Bank of New York and the Federal Reserve Bank of Dallas have come up with high frequency private data from private sources. And the Dallas Fed has now taken the ball. And for those of you on the call, go to their website, Federal Reserve Bank of Dallas, check the weekly economic index. It's the WEI. And it's got 10 components that are all basically private sector related. They publish this Thursday, every Thursday, Jason, every week. And this is data that is either daily data or it is weekly data. Let me just go through a couple of the components. There's something called Red Book, same store retail sales, a private organization. The data is copyrighted. Uh, People subscribe to Rasmussen to get same store retail sales. Anyway, the Dallas Fed gets it and puts it into this composite index. Let me show you a couple of other components. We have something called the Rasmussen Consumer Index. This does a survey every day of consumer attitudes and views. We have a staffing employment data that's also available on a real-time basis every day in terms of staffing. We have steel production, which we can get from the Steel Producers Association on a weekly basis. We've got railroad traffic. We've got fuel sales, electricity usage, and even during the shutdown, Jason, we were getting data on income and employment tax withholding from the US government. The thing that they didn't have were the weekly jobless claims. That data was not available. But this data has been coming out every week, every week. And the latest index that we have for the middle of November says that this index correlates with the US economy growing by 2% from Q4 of last year to Q4 of this year. Doing a little bit of math on it, Jason. Hey, we know what Q4 was last year. If it's 2% up from there in Q4 this year, as of middle of November, what does that mean for the growth third quarter to fourth quarter? It means the US economy is growing by over 1% at annual rates, real terms, in the fourth quarter. So even with the shutdown, we're doing okay. So I'm really excited because I'm going to use this weekly economic index all the time because it is so up to date. It's basically, moving something like 4 weeks ahead of time in terms of the information we have. So remember, rule number one of forecasting, try and get today right if you want to focus tomorrow. And to get today right, it's better to have data for the daily and weekly numbers for mid-November than a month earlier. Yeah.
And
So this is good stuff.
I think people, given AI and the access to information, people are expecting more and more timely information and the ability to make more timely decisions. I wonder what you believe the impact AI is going to have on the job market, both in Canada and the United States, both from a positive and a negative perspective.
Well, I saw a story just this morning looking at on the internet talking about a recession in management consulting. A lot of management consulting work can be done now by the companies themselves. They don't have to spend a month's worth of time with half a dozen consultants putting a strategic plan together. Using AI, you can do it yourself over the weekend. That's just one example. And I think that even for small business, this is going to be tremendously important because people people sometimes forget about small business. Small and medium-sized enterprises, SMEs, they account for, it's basically half of Canada's economy. The latest number counting says that something like 48, 50% of Canada's gross domestic product is produced by small to medium-sized business enterprises. So I think that's a huge impact. And when the young tech guy was over fixing my computer on the weekend so I could be on the Zoom with you, Jason, I didn't tell you about this. I didn't want to worry you that my computer wasn't working. He said to me, Mr. Andersen, he said, I'm interested. He said, in your business career, what do you think the most important advance has been? And I hesitated for a moment. I was first going to say the internet, but I guess then I'd say the internet combined with artificial intelligence. And it's right here. But again, that doesn't mean, Jason, that we're free from a stock market crash, the risk of one in 2026.
I think, again, to timeliness, I was on a call earlier today with an engineering client. And at the end, he said, "You've got this guy, Fred, on the call with us who's taking notes. Do you think we can get those notes at the end of the call?" And I think it's just a change because those notes summarize everybody's responsibilities and tasks that they have to deliver. And in the past, the client might get those notes in 10 days to 2 weeks when we've had time to summarize them and allocate jobs. And clients now are asking, can we get those notes right away? And it's just moving up the whole timeline. And I think I was at a conference last week in Munich, and we had hired a couple of leading world experts on AI and digital transformation. And they went back to when the internet came on, and the internet was great and everything else, and what's it going to do? But I think everybody today looks at the internet just like electricity. They just assume that it's there. And I think the comments were that AI is going to be just like electricity in 18 to 24 months. And people are going to figure out which bots you can use, which bots you can't use. But I think the expectation is to be able to make almost real-time decisions based upon economic forecast, getting your information back from your professionals. So I think timeliness is going to be a big effect. And I think one of the big questions is what is going to happen to the job market when a task that took 40 hours is now going to take 4 hours.
Exactly. And you translate that into, computer programming, coders. I mean, Jason, 10 years ago, it was a big thing. If you had an ability to be able to code software, you don't need people to do that anymore. AI has taken over the business of coding software. So, I mean, yeah, expect the unexpected. You mentioned an interesting thing about electricity. Jason, um, I've always been interested in economic history and economic development. And one of the things that happened, manufacturing used to be based on steam power, water power, and then steam power. And then with the electrification in the 20th century, in the 1900s, the first part of the 1900s, with electrification of manufacturing, it took several decades to get the infrastructure compatible with the new invention, electric power. Because the factories were built in the wrong places, they were built the wrong way, they were built to operate on steam power or water power. It didn't happen overnight. But I think right now, things are happening overnight. For example, on my monthly report, here's the sales pitch, Jason. I apologize. On my monthly report, what I did last month when I put it together, I asked AI to summarize my previous month's report. So I just handed over my previous month's report and I said, please summarize this. And that gave me a really good idea as to what to focus on as I come out with my next monthly report. So things that I never thought of. But I just wanted to mention that when we went from steam to electric power back in, 1910 thereabouts, it did take a while for manufacturing to figure out how to configure itself. And I
And
think we're all in the business still trying to configure ourselves. So, Jason, in your firm, in Ernst and Young, where I used to be, even at the Bank of Canada, did you notice the Bank of Canada is cutting, what is it, 10% of its workforce? Um, yeah, that came out just after a day or two after the budget was announced.
one of the issues Canada has had over the last decade is with cost increases in the US, their productivity has kept up with their labor increases. In Canada, we've had similar labor increases in cost, but our productivity continues to go down. How do you think Canada in today's trade world is going to be able to deal with that productivity shortfall?
Well, hold on. Isn't the November budget going to solve those problems?
Well, I didn't read that last night.
I thought I saw that the November budget is going to improve Canada's productivity. I think I saw that. And I think we've all seen that in the days since the budget came out. So isn't that good news, Jason? The government is going to help the private sector increase its productivity. I think that's interesting. I kind of want to see how that plays out. Anyway, let me get back into my presentation, Jason. I've got two things that I want to say here. First of all, looking at data and forgetting opinions. And I think one of the biases is partisanship. Partisanship is coloring the way people think. They're getting the political stuff in their heads and they're kind of getting a readout on how the economy is doing. The US economy in the second quarter of this year, and I'm mentioning this first, they're the 800-pound gorilla, right, as far as Canada is concerned. The US economy in the second quarter of this year grew at an annual rate, quarter to quarter, from the previous quarter, the first to the second, annual rates, real terms, at a 4% rate, 3.8. And in the current quarter ending in September, the US economy, we have something called a nowcast. We can take all of the data that's compiled and that's out there as of the end of September, put it into the formula, crank out what Q3 would be like. We haven't seen that data yet. It's still an outcast. Almost 4% again. So two back-to-back quarters with the US economy in price-adjusted terms growing at a 4% annual rate in Q2 and Q3. So, I mean, that is, again, a message. How to forecast? Well, get today right. And today is that going into Q4, we have had a lot of momentum in the US economy. Despite what people are saying in consumer confidence surveys, American consumer spending has held up really pretty well. Maybe for lower income groups, there's been a squeeze, but for middle class Americans and Canadians too, that have investable assets, there's a tremendous wealth effect going on that has kept the consumer going. But in the United States, something different is happening. So this is, I can go to my first slide on this. So let's go to my first slide. And it's coming up, everybody. And there it is. Bang. Jason, this is the best indicator I have of what's going on with business capital spending on manufacturing and on machinery and equipment, and also on software. And I'm looking at new order bookings for capital goods, business capital goods. I'm taking out aircraft, I'm taking out defense to give the underlying trend. And the reason I have two lines in here is one of them is the actual month-to-month data. The other one is a 3-month moving average that smooths that bumpiness up a bit, out a bit. So this is a leading indicator with a 3 to 6 month lead time on what's happening with business investment in the United States. And it's booming. It's booming. So why is this happening if things are so bad, if confidence is so weak with consumers? Bottom line is that the business sector in the United States is planning on expansion. You wouldn't have CEOs approving this kind of a capital budget, this kind of an investment intentions plan, if they thought 2026 was going to be a bad year. So where's it coming from? Well, a lot of it's coming from reshoring. There is a lot of reshoring taking place, bringing the supply chain back to the United States. But Jason, it's happening in Canada too. There is a reshoring that's taking place in Canada because Canadian companies want to have more security and more timeliness with their supply chain. And, people say, how can you do that? Labor is so cheap in China. Are we going to really make, tennis shoes in Canada, tennis shoes in the United States? Well, that's not the point. A lot of the stuff that's being brought back to North America is kind of inputs that are higher level than just t-shirts and running shoes. And they're also using artificial intelligence. So that advantage that countries in Southeast Asia, Asian Pacific countries with cheap labor, well, given artificial intelligence and the application to manufacturing in North America, that cost differential is being greatly narrowed. But anyway, I wanted to show you this one. I wanted to show you the business investment trend because this is good news.
How or what effect will Trump's big beautiful bill have on this continuance and an increase expenditure given the tax policies
Yeah,
contained in that bill?
the OBBB. The criticism of it, Jason, is that it's short term, that it's only really going to give stimulus in 2026. and maybe in 2027. That's the criticism, that it'll only add maybe half of 1% to the growth rate in 2026. And then it's going to create a lot of deficit financing and perhaps higher interest rates. But contrast that with Canada. What is the take on the timeline that our budget is going to give to our economy in 2026? Our budget's long term. It's long term. How long does it take to build an LNG export plant? Oh, it takes about 5 to 6 years. Yeah, we'll be there by maybe 2032 or 2033. So that's all looked upon as being good. You know, we were taking the long-term approach. We're going to be more efficient longer term. The criticism is the exact same way on Trump's budget. Oh, it's just going to be a short-term boost. But Jason, I kind of like the idea of getting a short-term boost to the economy. And I guess that I would also say that compare Canada and the United States, and that complete write-off on equipment, that 100% write-off in 1 year. Canada, it's not the same. The US has it permanently. Canada is only a temporary deal. You know that. You're the expert. You can go into the
Yeah,
details on that.
I think what's happened with this big beautiful bill, and I've seen it directly with clients, is that people have thought about, is it the right thing to do is to open up a manufacturing or distribution facility in the US? And they just continued along. And when Trump brought the big beautiful bill in and the tariffs, it forced them to sit down and say, where should we have a plant? How close to our market should it be? How much more profitable can we be? And I'm seeing clients do that. And there's a lot of states in the US that have labor incentives, real estate incentives that make it very attractive for Canadian entities to set up and do business in the US, to take advantage of local markets.
Yeah.
Um,
Well, where this is taking place, the reshoring that's taking place in the United States, Jason, it's taking place in a different part of the country than you would typically have industrial manufacturing growth. Where it's taking place is in states like South Carolina. Um, it's taking place in Louisiana. It's taking place in Texas. Um, and so it's interesting because one of the issues always has been, isn't this going to cause a shortage of labor? Well, we don't have labor shortages in that part of the world at this point. So it's in a different part of the United States that we're seeing it. Um, yeah. So anyway, I guess that this is the key. The key that we're looking at here is it's going to be a good year for business capital investment spending, private sector spending. So that's one of the reasons I am optimistic and more optimistic than others as we look at the year 2026. Let's look at the next slide and let's talk about the central banks a little bit. Here we have us and them, Bank of Canada and the Fed. One of the reasons, Jason, that the stock market is not happy these days, the last couple of days, and you might have noticed that the volatility index, otherwise known as the fear index, VIX, which is the implied volatility from the Black-Scholes option pricing model on the S&P 500, it's bounced pretty high, and that shows risk. Well, the thinking is maybe the Fed won't cut rates on December 10th. I think, and I'm pretty solid on this, the Fed is cutting rates on December 10th. And the reason is that the Fed is worried about the job market. I think it's partly because of AI. I think that AI in itself is causing job loss. But there's more than that too, because I do think there's a squeeze on SMEs, small and medium-sized enterprises, because input costs have gone up because of tariffs, but The increased costs, only about one third of those increased costs have been put on to consumers, have been passed through. So there's a squeeze on profit margins in the United States, especially with SMEs. So we have another private sector job market survey in the United States. It's the Challenger Layoff Report. It's a private sector uh, company, um, and it's proprietary data, but they do give you the headline numbers. And the latest number we had, for the month of October, we had more layoffs in October in the States than any October since 2003. Got to go back 22 years to find layoffs as high in October as we saw this October. The numbers come out this week for the month of November, and stay tuned for that. Anyway, the Fed is nervous about this. They are going to cut again on December the 10th, and I think they'll cut one more time also on December the 28th. Because the bottom line, if you take a look at where we are now with the policy rate in the United States, it's 3 to 3.25 to 4%. Jason, that is still above what we think the natural rate would be. The natural rate is kind of one of these, I don't know, it's a kind of a holistic number that you can't pin down, but basically it's the rate that's the best rate in terms of inflation and jobs. It's the one that's the balancing good rate. We are still restrictive in the United States at 3.75 to 4%, and we've got layoffs that are getting more important. It's interesting, you're seeing the layoffs at the same time that business equipment spending is looking really strong. Whereas on the right-hand side, this is where we are now in Canada, 2.25%. We have private sector home builders on the ropes. We actually have home builders in Canada, people who build low-rise, single-family, suburban homes. They're laying off workers because sales are so brutally bad. The only reason that housing starts are holding up, we had them out this morning for Canada, is because of multiple rental purpose-built construction. We're not seeing it with the normal low-rise family suburban homes that you'd expect. Nonetheless, the Bank of Canada is done. They're not going to cut interest rates anymore. We don't see a cut on December 10th, the 28th of January, or March 18th. So the Bank of Canada is done with cutting rates, much to the, oh gosh, much to the concern of the Canadian home builders industry. So anyway, that's
Peter,
the outlook.
with the lack of reduction in interest rates, what is the solution for the condo market in urban centers in Canada, which is projects aren't closing, people aren't closing, closings are deferred. A lot of condos are underwater, and I think I've been around in the beginning of my career when we had a condo. I don't even, I won't call it a
Sure,
bubble. The whole condo market
sure.
disappeared.
Yeah,
And
it's
how do
even
you see
worse.
Canada getting out of that out
It's
of that
even
problem?
worse right now in Toronto and Vancouver, Toronto in particular. Well, for one thing, Jason, they built the wrong kind of condos. They were building condos for foreign investors who wanted to have some kind of North American asset, and they'd rather be in Canada than the U.S. And hey, who wants to live in a 600 square foot condo, right? With a combined kitchen, living room, the whole thing. Yeah. No, the product doesn't fit with the market. So I don't know if there is any kind of immediate solution. The solution that we saw in the budget completely ignores ownership Middle income ownership housing is completely ignored in the budget. Yeah, sure, they have the proposal to eliminate the GST on for first-time home buyers. Walk me through the timeline on that, Jason. When was that idea raised? I think it was in May. It's still working its way through Parliament. It's still in the committee stage. It still has yet to face amendments, and it still has yet to go to the Senate. Talk about government efficiency. So it's only for first-time homebuyers as well. And so what they've come up with in the budget, hey, would you like to live at Downsview Airport in social housing? We've got a nice social housing project for you at Downsview Airport. And yeah, it's going to be low income, low cost, because affordability is the key problem. So it's kind of for low income, social housing, made out of prefab units. Now, I think prefab units can be very good, but I hope my kids don't have to move there. So go to the Canadian Home Builders Association. Go to their website, CHBA, okay? Canadian Home Builders Association, CHBA, and see what they are saying about the budget as far as housing is concerned. Complete disaster. Anyway,
Given your thoughts on the Fed and the Bank of Canada, where do you see long-term bond yields?
well, long-term bond yields don't get decided in Canada. I learned years ago when I was working for Jack Lawrence at Burns Fry, when I was their economist. If you want to get the numbers right on long-term bond yields in Canada, spend 75% of your time figuring out what's going to happen in the United States. And if you can get that right, throw in a bit more in the way of detail for a little bit here and a little bit there. But the key factor is going to be what happens in the United States. The other thing, Jason, is when I had the privilege of teaching finance for 10 years at the University of Texas, there's a theory, it's called the unbiased expectations theory. And that is that the 10-year bond yield is basically the average of what people think 1-year rates are going to be for the next 10 years. Okay? We know what the 1-year rate is right now. What is the expected 1-year rate a year from now? What is the expected 1-year rate 2 years from now? And so on. Average those all up, and basically that's how you figure out where the 10-year bond yield is going to be. The 10-year yield is the key. That is the benchmark. That's the one everybody follows. Okay, if you do that, remember, Jerome Powell, the chairman of the Fed, his term is up on the 15th of May, 2026. He's still going to be a board member until 2028. I don't think he'll stick around that long. I think as soon as they put the new head, the new chair of the Board of Governors in, when Jerome Powell is done on the 15th of May, I think he'll leave. And the Fed is going to be much more focused on getting short-term rates down. So that translates into, what do you think 1-year rates are going to be over the next 10 years? Well, I would say in year 1 or year 2, they're going to be lower now because it's not Jerome Powell anymore. So I would say you're going to be under 4%. You're going to be under 4% on the 10-year rate in the United States. And that means that mortgage rates, the basic 30-year fixed mortgage rate in the United States, which was bouncing around 7% beginning of this year, I think it's going to be in the 5% range before you know it. So there's some hope out there for the spring selling season in the US for housing. Let me go a little bit into, and I'm kind of looking at the time here. Wow. When we're having a good time, Jason, time flies, doesn't it? I've got 10 minutes to the hour. Let me go to this next slide on the governor, on Governor Macklem. Okay, this is what he's saying, everybody. He's saying that where we are in Canada, it's more than just a business cycle. This is something structural, and it's the tariffs. And by the way, remember what I said early on, something's going on there between Carney and Trump in terms of why we don't have a deal. I don't think we're going to get a deal because something's going on. Anyway, it's structural, the tariff damage, and Macklem is basically saying that because it's structural, I can't really do much about it. Interest rates aren't going to really help solve a structural problem. So I, at the Bank of Canada, can't undo the tariff damage. It's up to Department of Finance, it's up to Mark Carney, it's up to the budget. That leads us into the budget. This is the next slide. And Jason, you're the budget guy. You're the guy that would always explain the budget to me, but there you go. The thing I noticed, and it's the top bullet point here, a 78 billion deficit. Jason, that's the year that we're actually already in. That's the hole that we're in already. I mean, the fiscal year 26 ends in March. How many months do we have until that ends? We're more than halfway there to the end of the year, and it's 78 billion. It used to be that 40 billion was the top end. So deficits connect with interest rates because the government is going to have to either print money, okay, and buy these bonds itself, or the government is going to have to sell bonds to foreigners. And those foreigners, well, they don't want to pay as much. The foreigners don't want to pay as much for a country that's maybe going to lose its credit rating. So if foreigners don't pay as much to buy bonds from Canada, it means the interest rates go up. And how does that help? Maybe even infrastructure spending. So anyway, the major projects that are out there, I don't think housing is going to be the early recovery sector in Canada that it always has been. Jason, in the past, if you wanted to improve the economy, what you would do is you would get housing to kind of get going again. And I don't see this budget doing that with housing in 2026 or 2027. This social housing that's in the budget, it's all longer term. And that leaves us with the major projects, these 5 major projects. And number one off the line, LNG Canada. Yeah, it'll be up and running. When do you think, Jason? I would say 33 or 34, 2033, 2034. It's not going to help you much in 2026, 2027. I have to confess, Jason, that at my age, I've become a bird watcher. I do a bit of birding, and there's a place called Quintana. It's on the Gulf Coast, and it's close to Freeport. In fact, right behind the nature park at Quintana is the Freeport LNG plant. They have 3 trains. They're going to have a 4th train, probably well before LNG Canada. And the US is going to double its LNG capacity probably by the year 2030. Our project, LNG Canada, which is the number 1 project in the lineup, 2033 is maybe the completion date. It takes that long. I know. I go down to Quintana a lot, and I follow what's happening at Freeport LNG. I love to see the tankers. These tankers are incredible LNG tankers that fuel up there. Anyway, Jason, I'm looking at the time. I've got 5 minutes to the hour. Let me go to my last slide. Last slide is the Canadian employment line. I think a chart, a diagram tells 1,000 words. And look at the slope, 2023, 2024. Look at where we were in January and February of this year. And then look at where we were in the summer of this year. Basically the same as January, February. Now it's a bit of an improvement, but guess what? The unemployment rate in Canada is a full 2 percentage points higher than the unemployment rate in the United States. A full 2 percentage points higher. And I say that because, we measure it differently in Canada than the Americans do. We count a person as unemployed if they've just kind of read the newspaper and thought about it. The Americans don't say you're unemployed unless you have actually gone out and looked for a job and actually applied for a job. So the unemployment rate in the US is 4.3%. That's considered almost full employment. In Canada, the unemployment rate is 6.9, but we calculate it differently. We count you as being unemployed if you've just, hey, thought about it over coffee. So if you account for this difference in methodology, instead of 6.9, our unemployment rate in Canada is something like 6.0. It's 4.3 in the United States. They're at full employment. I can't understand how Canadians are willing to put up with an unemployment rate full 2 percentage points higher than in the United States. So anyway, there you go.
Peter, I have
We
one last.
are we are in trouble, I think, Jason. And my advice to people on the line for get ready for next year: watch the data. Don't listen to opinions. Watch the data. Prepare for the unexpected, but emphasize risk management. Emphasize risk management is kind of my message. Sorry, I interrupted you, Jason. Fire away.
I had, with respect to trade and our group of premiers and the Prime Minister and his team are constantly talking about Team Canada and staying together. How is this group of people going to reconcile their differences when you have Ontario in direct competition with China and having 100% tariffs, and China having a tariff on canola from Saskatchewan and Manitoba? And then federally in the US, you have the relationship that Alberta has in Saskatchewan with potash and oil and gas.
Mm-hmm.
And then you have lumber in BC and the automotive industry in Ontario. It doesn't seem any of the players on the team are on the same line, or they're going to get on the same line. So I think you indicated we're not going to get a deal. And I see some of these factors as people's interests are different. How do we reconcile that in such a diverse country?
Well, unfortunately, I think it's the politics. That's where the Team Canada stuff comes from. I understand. I watched all 18 innings. Okay. I watched all 18 innings. And in game seven, going into the ninth inning, I went upstairs and got my old 1993 Blue Jay shirt and put it on. So I understand, the national pride and all of that. But hey, we're not fighting an election right now. We're wanting to do a business deal with the Americans. And yeah, we can do business deals with other countries, but it's only going to be a kind of a small offset if we're not going full bore with the United States. So I'm not a politician, Jason. That's why I'm not working at a big bank as an economist. I don't want to have to tell my boss what he wants to hear. I like to be independent. I don't have a solution because I'm not a politician, but I would say and this has probably seemed strange for someone who lives in the United States, don't let the politics mess up your thinking. Don't let the politics mess up your thinking. If a business deal has to be done, well, then you be pragmatic. And I like Mark Carney because I think he has been pragmatic. I like him more today than I did 6 months ago. I think Mark Carney is a great leader, and I think he does also get along with the Americans well. I mean, he should. Who did he work for? Goldman Sachs? I think he did. Uh, but in any case, I guess what I would say is that it's going to be a tough year. The fact that we haven't done a trade deal by the end of this year means that next year is going to be more complicated because it's not going to be just a kind of routine uh, refreshment of what used to be called NAFTA. This is going to be more hard nosed now. And so it's a big problem, I think, for business confidence. Whereas business confidence in the United States, given the most recent information, and Jason, we had a survey yesterday. It was called the Empire State Manufacturing Index. Okay, it's produced by the Federal Reserve Bank of New York. It showed that the index on business conditions for manufacturing in the New York region, 200 firms in the survey, is the best since this time a year ago. So, the American business community is feeling okay, and in fact, better than we realize. Whereas Canada's business community, especially the small and medium sized businesses, are really seeing their profit margin squeezed.
Okay, well, Peter, this has been great. If people have questions, they can send them to me. I will speak to Peter and get his thoughts on those questions. I think, as always, it's been a great hour, providing insights into where 2026 is going. Thanks, Peter. Thanks, everybody, for joining Zeifmans today for this economic briefing. Thanks very much, and you'll get your copy of the recording later today or tomorrow. Thanks very much.